At first, a savings account feels comforting. Your money is safe, it's protected. It's just sitting there waiting for you. The bank even reassures you. It's insured. You can withdraw anytime. Nothing risky here. And you believe it. Because this isn't investing, this isn't gambling, this is being responsible. But here's the strange part. While your money is sitting still, the bank is busy, very busy. Today, we're going to talk about how banks make money from your so-called safe savings account. Not through conspiracy, not through tricks, but through a system so normal, so accepted that most people never question it. And once you see it, you'll never look at your savings the same way again. Here's the story most of us carry in our heads. You earn money, you deposit it into the bank. The bank holds it for you. Simple. Your money stays there. You can take it out whenever you want. The bank gives you a little interest as a thank you. That's the mental model, a storage locker for cash. But that model is wrong, because banks don't store money, they move it. The moment your money enters a bank, something important happens. Legally, that money is no longer yours in the way you think. You don't own a pile of cash inside the vault. You own a promise. The bank owes you money, and in return, the bank gets permission to use it. This is called fractional reserve banking. Here's how it works simply. If you deposit $1,000, the bank keeps a small portion and lends out the rest. Your $1,000 is now doing multiple jobs at once. You think it's resting, but it's working overtime. You deposit $1,000, the bank lends out $900. That $900 gets deposited into another bank. That bank lends out $810, and so on. No new money was created by you, but the system multiplied it. This is how banks expand the money supply, quietly, legally, every day. And every loan generates interest. Which brings us to the real engine. Your savings account might earn 1%, maybe less, sometimes almost nothing. But the loans made using your money, credit cards, mortgages, business loans, those earn 5%, 10%, 20% or more. That difference is called the spread, and it's one of the most reliable money machines ever built. The bank didn't create the money, you did, but the bank captures the upside.
Now, to be fair, banks provide services. They manage risk, they provide liquidity, they keep systems running, and yes, they protect deposits. But notice the psychology. Your reward is framed as safety, not growth. You're paid in reassurance, not returns. The bank says, we'll take care of it, and most people accept that trade. Here's the part few people calculate: inflation. If prices rise 3% a year and your savings earn 1%, you're losing money every single year. Your balance goes up, but your purchasing power goes down. The bank still earns its spread, you absorb the loss. The ideal customer isn't reckless. Someone who deposits regularly, rarely withdraws, doesn't question interest rates. The longer your money sits untouched, the more valuable it becomes to the bank. Not because it's large, but because it's predictable. This isn't about villainy, it's about incentives. Banks are businesses. They optimize for returns. Savings accounts aren't designed to make you wealthy. They're designed to make the system stable. Understanding that changes how you think. The real question isn't, are banks bad? It's this: are you using a savings account for what it's actually good at? Or are you expecting it to do something it was never built to do: grow your wealth? Because once you understand how banks make money from your savings, you can decide where your money should actually live. And that decision matters more than most people realize.